Well, it's 9 o'clock. Good morning, everybody. Welcome to the second workshop that the Southeast Region Beef and Forage Initiative team put on. In the interest of time, I'm going to dispense with introducing all the agents and specialists that have been put this effort together because we did not build any time for a welcome. I don't want to take away from our first speaker. But apologize for sending the late link. It got hung up in my outbox yesterday afternoon. I had it timed to go out at 5 o'clock, so I'm glad everybody got on that's on here today. So the other thing that we did not do, we put in a question and answer at the end, and we're just going to moderate it. Dr. Anderson, let's just see how it goes as far as if we have time to take any questions at the end of your presentation. And I'll monitor the chat box. And also, if we do have time for live question and answer, you can also raise your hand, and then the speaker can recognize you. But we got a pretty good slate, and we don't have any breaks that are built in. And so we're just going to go from one speaker to the next. And I noticed that everybody has their video off, which is good. We want to save the bandwidth, and it just takes up too much bandwidth if you have your video on. So I think that's all the housekeeping stuff. Unless we have any questions, we're going to go right into the program. Our first talk is just a beef cattle market outlook. And Dr. David Anderson, he's our extension economist out of College Station, is going to lead us off this morning. Dr. Anderson, I'll turn it over to you.
Hey, thanks. It's great to be with you guys this morning, and I appreciate the invitation. I think you can see my slides up there. We just stuck this one up a few minutes ago, just so there was something on the screen, and I'm certainly glad to be with y'all to talk about really, I guess around the house and around the office, I've just been calling it the Rona for quite a while, and really, I think we'll spend some time about how cattle markets are adjusting. And with that, heck, let's jump right in. I want to spend a bunch of time showing some charts and talking about how we're adjusting, both in production and prices, because I'm an economist, and I'm going to start out from the point of view markets work and incentives work, and we got a heck of a lot of huge changes going on, and we certainly see these adjustments going through the production, and it's rippling back to the cow-calf side, and it's going to ripple forward from there in coming years. And so we really want to talk about adjustments and prices adjusting as well, because that's really how markets work, is prices adjust. I do want to say right up front, I think I've put this together where we're going to have some time for questions, and I'd love to get to some of those live questions as well. So I look forward to that. And I would certainly say these adjustments that we're seeing really due to coronavirus effect throughout our economy is really firing up a lot of interest, a lot of passions in our industry about a whole host of topics, about price manipulation by packers, packer returns, country of origin labeling, price reporting, price discovery, beef demand, and just hosts of these topics have all come up, and I'm certainly game for any kinds of questions along those lines as well. I won't probably directly address those, but we can certainly take our discussion time in those directions as well, because I know those are so many concerns of so many of us in the industry going forward. So I certainly want to encourage questions like that as well. So I think one of the things I want to keep in mind is every time we hear somebody say, well, gosh, these are unprecedented times, whatever, looking for whatever word you can find that's different than unprecedented, but means the same thing. I think really if we just make sure we keep in mind that times are not normal, the effects of coronavirus throughout our economy are not normal. And we shouldn't really expect cattle markets to, we ought to expect not normal there as well. Volatility, huge amounts of price volatility, lots of uncertainty going forward in terms of prices for calves and prices for cattle in the future. All this shift from restaurants and grocery stores, yet now we've got restaurants opening again. Packing plant closures and slowdowns. Those are certain. None of these things are normal, and so we see, if I can use the word unprecedented again, we're going to see. We certainly have seen and will see unprecedented volatility and uncertainty in prices. Yet there's a lot of what we're seeing makes complete sense from an economist standpoint, from markets working. And so let's keep that in mind as we go forward. I think there's some keys going forward. Volatile prices is certainly one. We ought to consider and put some thought into. We're certainly in a recession, and recessions change our purchases. We know from the Great Recession that consumers bought beef, but they bought fewer steaks and more hamburger. And so we have those kinds of changes going on, changing relative values of the meat that we're eventually producing. So we have that going on as well. And with the recession, we got millions of folks unemployed, and that has hit in about 3 months' time. And with more unemployment comes reduced incomes, falling gross domestic product, and really the question of, which is I think the key question going forward, is what does this recovery look like as we reopen again? What's the path of this? You'll see lots, if you watch the financial news or read some of the financial papers, is this a V-shaped recovery or an L or a W or whatever it is? Really, those kinds of paths and what we experience are, I think, a fundamental key going forward. I would also suggest that I think these are the effects of this are going to ripple through the cattle market for a long time, simply because as we go from sort of the restaurant shift, we ripple through the coronavirus on our employees at packing plants, slowing down cattle slaughter, reducing placements in feedlots, falling prices, and then the effect of that in the cow-calf sector, and then the effects of what happens and really how many cows we hold back for next year. The effects of that are going to ripple back through the system from the cow-calf side on. So if we think about fundamental type things, I think there's some things we might think about in terms of long-term versus short-term in a price outlook type of thing. And I will say, as I routinely do at the end of this presentation, I'm going to build a fundamental case for where I think prices are going, and then I'm going to show you my price forecast for the rest of this year, and we can talk some about 2021 as well. So, with that is sort of our, a base kind of setting some keys to kind of think about and how I look at the cattle market. Let's jump into a bunch of charts. Heck, I'm an economist. I can't do anything without a bunch of charts. And let's just jump in here with some of these. And I'm going to start with the number of cattle that we are slaughtering weekly. And I'm using a chart here for total cattle. So that includes fed cattle and cows. Heck, if we look early in the year, up through March, we were running ahead of a year ago. We had large numbers of cattle on feed. We had plenty of cattle to move through. Plants were operating at full capacity, and we were moving animals. In fact, I would argue that some of this real spike when we got up to 685,000 head in a week there in March, we moved a lot of cattle because the futures market was already collapsing in March as coronavirus was picking up and everybody figured we were starting to see changes because of it. That wide basis spurred a lot of feeders to move cattle to feedlots. To packers. And we moved a lot of cattle ahead of time because there was a price incentive to do so. So at that point, we're really dealing with restaurants closing, the shift over to grocery stores, all of us consumers stampeding into grocery stores and buying everything in sight. Then we get into April, and coronavirus hits employees at packing plants, forcing some closures, forcing changes in how we operate in terms of distancing, trying to get people apart, trying to react to what was going on in our labor force. And I would suggest then too, and you can see that decline. We went from a peak of 685 back in March down to almost 435,000 head. Back in this April, May, you can see the full effects of this decline with plants closing. We start to see plants open. We see plants, I would argue, really figuring out, once we get closed plants open, but there's a lot of figuring out how we're going to do this. And that has taken some time, yet look at where we are today. By the way, that sharp decline about 2 weeks ago reflects Memorial Day. You take a full day slaughter or working out of a week, and you see that decline. Yet this rebound, we're back above the 5-year average, just over 635,000 head last week versus 660 a year ago. We're rapidly approaching back to capacity where we were before. And I think that reflects not only plants open, but a lot of just plain learning and figuring out how to run in this new environment that we're in. Yet, so we're catching up. But certainly this extreme decline in slaughter and then rebound is one of these ripple effects that we're talking about, really driven by coronavirus and our employees. So, a lot of times I like pictures, and I think this is a really effective picture at putting some of these numbers in terms of context, and are we getting back to where we were? And I think we're getting back there. We're not back completely. And it may be a long time before we're back completely. Yet this ripple effect caused by this slaughter, we still had cattle on feed. We still had cattle ready to go. And so we've got this backlog. Let me point out one of the ways that I think that segment of our market has adjusted, and that's through Saturday slaughter. We tend to think of Saturdays as being sort of a half day. You're cleaning up the animals you've got left through the week. You may have some more to run. It's a catch-up day. Broadly speaking, we think of it as sort of a half day. Yet if you look at this rate of moving cattle through on Saturdays, it really did not slack off near as much as the total weekly slaughter did. And I think this has become one of the ways we catch up. One of the ways that we've been able to adjust is shifting around and doing Saturdays more. Probably, see some more Sunday slaughter. And even though that's not reported, when we do run plants on Sundays, it's often reported in Monday slaughter. So that's part of this learning process. And I think that's an interesting thing to look at and think about how we redo things, how we get going in how we learn and adjust. Dressed weights, when we start talking about backed up cattle, we certainly saw an uptick in terms of weights while we were declining seasonally at a higher level than both the 5-year average and certainly from 2019. We got down to about 885 on steer dressed weights, and now we've been pushing back up to about 900 pounds or so. We certainly see the effects of backed up cattle really moving kind of counter seasonally until we start being able to catch up and those weights start to decline a little bit, which we have in the last week or so. But still, certainly producing more beef per head, which we were already doing all year long. The backup, I think, just exacerbated that a little bit. But even so, if we put together number of cattle going to market and weights, and we think about that in terms of beef production, last week we were right on top of where we were a year ago in terms of beef production. And so as we think, even though slaughter continues to lag with more weight per animal, at least in terms of pounds of total beef production, we've caught back up to where we were. And I think that's a pretty important consideration. As I show some prices in a few minutes, but we start thinking about what we normally see in summer in terms of fed cattle prices they tend to decline in the summer because beef production is typically pretty large. And so we've already caught back up in beef production, even though slaughter's still lagging. And that's largely a weight story. So I think that's worth considering as we think about the two parts, it's the number of head and the weights to get to beef production. The next part of this rippling effects, if we have this log jam at packing and we can't move more cattle through, I think one of the next step in that as we back up is really in terms of cattle on feed. How many do we place? And I'm going to show that in terms of the total number of cattle on feed. But if we looked at placements in March and April, we actually placed more than 20% fewer cattle on feed compared to the year before. So a couple of months of more than 20% decline in placements, and we dragged down cattle on feed by a good 5%. And so, the next, as we see adjustments, how are we adjusting to this and rippling through? Certainly feedlots are the next part. And we certainly see an adjustment there in terms of fewer placements and fewer cattle on feed. But that also means that those, we already produced those cattle, right? Heck, the calves were already born. The cattle were there last year and went through wheat pasture, winter grazing programs. Heck, they were ready to be placed, yet we're not placing. And so what we've done is we've backed that up to the next level as well. So those cattle are out there. So again, think of this rippling effect going back through with time delays, because if nothing else, it's a biological nature of production. And so, all of these are rolling back through the system. And so I think cattle on feed is a particularly important thing to look at. And the next USDA monthly cattle on feed report will come out next Friday. So we'll get a little look next Friday at what happened in May in terms of placements and get that June 1 number and see if we continue to see how we're continuing to adjust, or are we starting to place more and starting to get back in the flow of placements now that the packing side is adjusting a little more as well. So let's talk a little bit about prices, and I'm going to start with fed cattle prices. And I want to point out a couple of things. Again, this red line is the 5-year average. The dotted line is last year. The blue line is this year. If we look back in January, we were about the same as the year before. February, we saw, compared to 2019, falling prices. Excuse me. And certainly falling prices in March. Again, with large production. In fact, we had beef production up about 11% in March, year over year. We had slaughter up a good 6% in terms of fed cattle slaughter. So typically with more production, we get lower prices. We were already seeing that when we started seeing the effects of closing restaurants, the shift to grocery stores going on. We saw a little rebound as people, and I'll show the cutout value in a little bit, but we saw some rebound in fed cattle prices, and then this sharp decline. This decline from about 119 down to 99 bucks really reflects packing plant closing and slowing down. And I'm asked a lot, this leads us to a lot of industry worries about market power, price manipulation, things like that. But I'll tell you, as an economist, if you'd have walked in my office, and I've used this story a lot, particularly in regards to last fall and the packing plant fire that closed one plant. But you know what? If somebody would have walked in my office cold and said, what's the effect of closing packing plants? And economically, the effect is going to be, if you think about a plant, what are they doing? That plant is buying fed cattle. So they're buying cattle. If that plant closes, they're no longer buying. So we've lost some demand for cattle. And if you lose some demand, you get lower prices. At the same time, that plant produces beef. And so if the plant's not running, they're not producing any beef. And all of a sudden, while we've lost demand for the live animals, we've lost supply. We've cut supplies on the beef side because we were unable to produce it. In fact, I might ought to not say we've cut supplies. That implies we did it on purpose. In this case, the plants were shut down, not because they wanted to be, but because of coronavirus. And so if we think about lost supplies, we ought to see higher prices for beef and lower prices for fed cattle. And I think we've seen that exactly. Yet as we see plants begin to reopen, plants begin to figure this out and run at faster and faster speeds as we learn and adjust, we see higher cattle prices because of it. And right now, for the last couple of weeks, we're basically sitting on the about where we were a year ago. One of the things I would point out is as you read things on the fed cattle market, you see prices throughout the week. While I'm showing here weekly average prices, one of the things we've been experiencing over the last number of weeks is a much wider range, I think, in terms of prices throughout the week, where even last week, I've got an average on there of about 113, yet cattle sold anywhere from about 105 to about 118. So I think one of the things we're experiencing is some wide differences, a very wide range in fed cattle prices, not only regionally throughout the country, but within that week as well, whether you sell early or late. Characteristics of the animals being purchased, a number of all of those things. I think we're seeing a little wider range than normal in generating this weekly average. Yet as a weekly average, we're pretty close to where we were a year ago, heading into the time of the year that, summertime, that we tend to see larger production anyway. So with that, I already sort of mentioned what we ought to see in terms of meat prices is higher prices. And if we look at this based on the choice boxed beef cutout value, it's pretty easy to see that sharp increase. I mean, heck, we went from 237 to over 450 in terms of a weekly average choice beef cutout. If I took a look at the last couple of days, we'd be back down pretty darn close to that fat red line in terms of daily cutout values. So as production is increasing, we're really starting to see prices adjust again after the run up due to tight supplies. Now supplies are loosening up and prices are collapsing back down to very close to where they were before in terms of wholesale values. In terms of the calf market, just like we see in these other, what I showed in fed cattle, that expectation in prices, if fed cattle prices go down, we do see that effect and create lower prices for calves and feeder cattle. We certainly see that here throughout this, this March and April and May period. Yet those prices have stabilized a fair amount and are below where we were a year ago, but still, but pretty close to it. So if we were going to look at heavyweight, 750-pound number one feeder steers in the Southern Plains, we've certainly seen some rebound along with particularly the last few weeks from those troughs down in April, but some increase in feeder cattle prices really over the last few weeks, getting closer to where we were a year ago. So, as we look at prices adjusting, as quantities have adjusted, I think we see that exactly here as well. A large part of that decline in fed cattle prices is due to what we see in terms of placements. If placements in feedlots are down 20%, that means, we bought 20% fewer cattle than we did a year ago. So that, in a way, that demand for the feeders was lacking, and I think that shows up in prices. I want to show a couple of meat cut prices. We don't usually do this, but we often don't do this because we're more interested in the calf market. But given times like this, let's take a look at some of these wholesale beef cuts. I want to start with ribeyes. You think, if we go out for a steak, how many of us ribeyes are our favorite cut when we go to a steakhouse? For a lot of us, that's true. And this is a cut that's really affected in food service and restaurants. And it is pretty easy to pick out. Look at that blue line decline in April. Really, the shift as you know, restaurants were really closing. That March and April period, restaurants are closing. We're shifting to grocery stores. I would argue one other thing is going on there, and that is buying and planning ahead for recessions, because we know people buy fewer steaks and more hamburger, and I think that affects that wholesale buying for ribeyes. Yet, when we start slaughtering a third, 30 to 40% fewer cattle, all of a sudden we get a lot fewer ribeyes available for that demand that's there. And ribeye prices have exploded higher. In fact, almost doubled at wholesale. And we now have restaurants trying to reopen, and one of their input prices are these record high, darn near record high ribeye prices that they're now seeing those higher prices. If we take a look at chucks, I like to use a couple of these different cut prices because, a lot of times we talk of it as all beef, but all beef is not the same. We have different cuts. We have different uses of different things. Chucks, we all familiar with a chuck roast. We're all familiar, I think, with a flat iron steak. Yet we grind a lot of chucks for ground beef. And as we throw in recessionary buying, but also sharply tighter supplies, chuck prices took off because we needed more ground beef. And yet as supplies have begun to increase again, we've got those coming back to earth, and we're pretty darn close to where we were back in the first couple of months of the year. And so we're already seeing these market prices adjust to larger and larger slaughter levels. One more is just really boneless beef, 90% lean. You think about hamburger, all the different mixes of lean to fat you see at the grocery store. You think about the same thing in restaurants. This 90% lean, if we think about this reflecting our cull cow market, so much of cull cows goes to lean ground beef to mix with some fat from and some more fat from fed cattle to hit all of these different targets we want to see for different markets in the ground beef market, with less production and more demand for ground beef. We certainly see prices skyrocket, and those are starting to come down a little bit as well. But I would suggest if we look at the cull cow market, as I'm going to reflect on a chart of slaughter cow prices, Southern Plains auctions 85 to 90% lean, and we've been running above a year ago for the last month or two. Really, heck, if we were looking for a success story, cull cows have been a little bright spot compared to the calf market if we look at prices compared to a year ago. Certainly nowhere near where we were on the 5-year average, but certainly better than they were a year ago. And I think that's tied directly to what we're seeing. If we want to tie something directly to what we're seeing in retail and wholesale beef markets and that demand for hamburger at grocery stores, I think this is where it hits us most directly, is in our cow market. Just for completeness, I've been getting a lot of questions about trade, so I got 2 trade charts in just to do a little update on imports and exports. Until last month, this data came out last week. There's a lag in this data, so we just got, first week of June, we got the April import and export data. Thought I'd show imports a little bit. Certainly, we've been running ahead of a year ago, and but in April, our imports really dropped off compared to where they were in March. I think that reflects restaurant closures as much as anything else, because about 70% of what we import are lean trimmings to turn into hamburger. And a lot of that goes really to the restaurant trade. And so as our restaurants closed, I think we saw a pretty sharp decline in our imports as well. And so I think that's where that imports is hitting us yet, even though we were importing a little more beef the last couple of months prior to really seeing the coronavirus effects. If we look at exports, our exports really dropped off in April as well. I think a couple of things going on. Heck, you look at that decline in beef production. If we're producing less beef and our beef is higher priced, we're pretty uncompetitive in export markets. And I think that is really what that reflects. While we have seen some growth in some markets, a big share of this decline in exports is really exports to Mexico. Our exports to Mexico have dropped off dramatically, really due to recession in that country and a heck of a lot of coronavirus effects there as well. And so, I think their recession has taken its toll on the amount of beef they're buying from us. So I think that's my last chart in summarizing all of this stuff. So, heck of a lot of volatility. We've produced the cattle. We've struggled with a backlog, really due to this logjam at packing. I would argue that fundamentally, our beef demand going into this, we had over the last 4 or 5 years the best beef demand in 25 years. So from a fundamental standpoint of demand, I think our demand's been pretty good. At least we have that longer term positive factor going in our favor, even though we're hitting a recession right now. And that's typically bad for beef because beef is more expensive than pork and chicken. And so, but if we think long term about this, I would suggest something else, and that is cyclically. We peaked in cattle numbers in 2019. We had fewer cattle in 2020. Our cycle in terms of cattle numbers is on the decline. I expect fewer cows in 2021 than 2020, and falling production over the next couple of years just cyclically. And so as we think about that, we talk about cattle numbers having a cycle. There's also a price cycle. So as numbers decline, prices go up. I would argue that long term, I'm pretty optimistic about the cattle and calf market long term as we think about this over the next several years. Although certainly we're in a heck of a time right now with a lot of volatility and uncertainty in our markets. So kind of wrapping up that fundamental look at it, here's my price forecast. Price projections for the rest of this year. On my right, it says 500 to 600. That's a 550 pound steer reflecting Texas combined auction market values, which is going to be more centered north of us. And so what we normally see is the farther south we go, the farther east we go, we tend to get lower prices, if for no other reason than transportation. Remember, our market, where our calves are eventually going, is to a feedlot, and most of those are in the Panhandle, and so their transportation takes its toll on prices. 750 pound steers, fed cattle for completeness. I've broken these up by quarter, and 2017 is the annual average from that year. So we've got some comparison here. Let me pull a couple of things out that might jump out at you. If I was looking at third and fourth quarter 550 pound steers, you'll see my ranges. I've got higher prices this year than last year, particularly in the fourth quarter. I think there's a couple of really good supporting cases for some improvement in calf prices. One is that it appears that we've produced fewer calves this year than last year. So if nothing else, there's going to be fewer calves for sale this fall than last fall. Second thing, excuse me, looks like we're going to we're at least planting a heck of a lot of corn acres. Any kind of normal year production, we're going to have a record amount of supplies of corn and low prices. Low feed costs typically mean higher calf prices. They are supportive of calf prices. So I think we've got two important fundamental factors in our favor for some support for calf prices, even with all this uncertainty going on in the marketplace with what this recovery looks like, what fed cattle prices look like, what do beef prices look like, and what's our overall economy look like. So, I think certainly on the calf price side, I think there's some reason for some optimism. I've got a little lower price on my feeder cattle, my heavier weight steers than I do on a little lower price compared to a year ago for the rest of the year. Quite honestly, I think that continues to reflect. I've got some lower fed cattle prices, and those lower fed cattle prices on average are really dealing with this backlog and how we work through the backlog of cattle, how we work through placements going forward through the year. So really, that's my, the only two slides I got left, one says thank you on it. And I want to say thank you for inviting me to be with you all today. I really appreciate the opportunity to talk about some of this stuff and maybe focus our thinking on this stuff a little bit. And the other one just has my contact information. I love to get questions. I'll show you what it is. I'll tell you what, there's my email address. Shoot me an email if you got a question. I always like to hear from folks. The phone number down there at the bottom is my office number, but since they got a lot of us working from home, that won't do any of us any good. So probably shoot me an email. And with that, let me go back to this price slide. Again, I say thank you, and I should turn it over to any questions. Do you want? Let me ask this question. Do you want me to quit sharing my screen or just leave this one up there and while we field a few questions?
Oh, that's up to you, David. If there were no questions in the chat box, so the participants that are on here, we just unmute yourself and you'll start talking. So if anybody has anything, this is the time. We got about 10 minutes that we can entertain questions.
Hey, David, this is Joe. I have a question for you about cow prices.
Fire away.
So when you show that slide, I've been meaning to ask you this for a long time. So are those sort of like utility cow prices or commercial cow prices that you're showing? And can you kind of relate that to what that cow looks like to everybody that's sort of on the meeting?
Yeah, so I've gone back to that slide. I think that's a good thing. I kept sharing that. I think that's a good question. So a lot of times the data for slaughter cows, cull cows, whatever term we want to use, it's pretty thin sometimes, particularly in times of the year. I've gone to this kind of 85 to 90% lean. This seems to be a pretty consistent set of data going back a lot of years. So this is not going to be a cow that is, skin and bones or darn near nothing on them. It's also not going to be one that, gosh, if you look at some of the data, you'll see a term called premium white. A premium white cow is one that they've actually put some feed into and they've put some work into her to change that fat color from yellow to white. Because if you do that, there are some better prices in meat markets. These are sort of what I tend to think of as a shooting in the middle of that gap. These are cull cows, but these aren't sorry skin and bone ones, and these aren't the best ones out there either. That's not a real technical explanation. I think if we looked at some cutter cows, those would have lower prices. And those have been a little below a year ago, quite honestly. So this is something that I'm sort of shooting the middle. These are cows that are going to slaughter, not going back into the herd somewhere. So I really do try to kind of shoot the middle of the road with this. Does that help, Joe?
Yeah, Dave, it does. We always get a lot of questions. My cows are not never have brought anywhere near that price, except for about 6 or 7 years ago, remember?
Yes.
We had some cows that almost hit $1, because we just didn't have any lean trim. But yeah, I just, when we say slaughter cow prices, 85 to 90% lean, that's like, if you're looking at what that is, that's like about a body condition score 2 cow, but they're really not that thin.
Right. And they certainly are a cow that you're not going to keep. These are ones that are being culled. I try to compare this a lot of times just casually, week to week with local auctions. You know, heck, I think this average tends to run a little bit higher than our. If I was looking at local auction kind of average prices, this probably runs a little higher. If I was thinking about, and certainly with some of the range of cow prices of cull cows we've seen, gosh, you know, back in last fall, you see that dotted line got down to about $30. Yet, you know, we had cow prices. There were cows at local auctions that went for about 10 cents. Particularly really poor, thin, not much on them cows. And yet, if I looked at the average across some of those local markets, they would have been up, some even above that, based on the condition of the animal. So again, this probably runs a little better than our local auction values, but I am sort of trying to shoot the middle of a wide range of possibilities. That's a good question, Joe. Thanks for asking that. You know, I might go back to something else when I was talking about this backlog. You know, there was a couple of weeks ago, there was a lot of talk in sort of the popular press about, you know, we had more than 1 million head backed up, 1 million head of fed cattle backed up. You know, if I compared slaughter there in April to the same period a year ago, I'd get that over 1 million head backed up. That difference was over 1 million head. But if we think about how we adjust, you take a look at the reduction in placements, all of a sudden we had 700,000 fewer head on feed in April than we did the year before. There was a lot of adjustments to adjusting that backlog. It helped that we slaughtered so many in March ahead of this. Whether we consider that just getting lucky or, you know, the futures market may have actually done its job and signaled to get those cattle to market. They might, you know, in that case, it might have been right for the wrong reasons, but at least I think that worked in our favor, but also sharply fewer placements worked to reduce that backlog. But that there is a backlog, and I think that backlog is going to pressure fed cattle prices certainly over the next couple of months as we work through. But you take a look at all of a sudden with 500,000 or more fewer cattle placed on feed, as those work through, then all of a sudden we get some tighter supplies later on. And so, you know, we may see some significant movement in sort of our normal seasonal price patterns as these effects ripple on through the system. You guys got any more questions? I made it clear as mud. Well, I certainly hope a lot of these charts really highlight the adjustments that we're seeing, because there's a lot of adjustments and it's really rippling through our whole industry. And I think we're going to be seeing some ripples coming back the other way in the next year.
Well, that was great information. Of course, I always like to hear the information when things are getting better. Really appreciate.
Let me tell you.
Really appreciate you, David. Last chance, guys. Anybody want to ask a question to Dr. Anderson? Don't be shy.